Hello, my name is Charlie Moran. I'm a senior analyst here at ValueLine. I'm joined today by two other senior analysts, Sharif Abdu and Alan House. We here at ValueLine hope you and your family are staying safe and dealing with this difficult time as best as possible. Today, we're going to provide an update on our outlook for the economy and stock market in the coming new year. We will also discuss the actions ValueLine is taking to help our subscribers navigate this difficult time. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Now, let's discuss the coronavirus, the economy, and the stock market. This content was prepared by Harvey Katz, ValueLine's chief economist. The rising toll from COVID-19 is having a direct impact on the economy. Thus, as infections, hospitalizations, and deaths all surge to record levels, resulting business shutdowns and disruption have cooled the nation's economic recovery. True, business activity is hardly collapsing, but recent trends are moderately concerning. For example, as December began, we saw lesser gains in both the manufacturing and non-manufacturing sectors. Also, there was a further softening in job creation, with November seeing just 245,000 positions added nationwide. That was less than half the increase tallied in October. The second half of 2020 will likely have recovered around 3/4 of the shrinkage in the first half. Going into 2021, with growth already slowing, the national and economic challenge will be a continuing surge predicted by infectious disease experts in illnesses and deaths through the winter months. The deeply unfortunate development may be expected to put more pressure on the economy. The mass distribution of vaccines, if done successfully, then should slow the disease's progression and put the economy back on a sustained growth track. But that outcome is hardly etched in stone. Meanwhile, investors will soon be looking to Washington, where as January arrives, we will see changes in Congress and the executive branch under the new president. It is hoped that such a reshuffling would help secure the passage of a much-needed fiscal stimulus package that probably would alleviate some of the financial pain inflicted by this pandemic. Even with such assistance, however, it may be tough going until mid-year. The upcoming year should end more strongly than it begins. Indeed, if the vaccines are distributed in a timely manner, the disease track could slow sufficiently to put the economy on a sustained growth track by the second half. Investors are focusing on the intermediate term, which explains the stock market's strength when there is good news on the vaccine front. Encouragingly, there continues to be only limited reaction to reports showing short-term economic headwinds. In conclusion, the stock market continues to set records and there could be more gains on the way. But as prices rise, so do PE multiples, suggesting a need for some caution at these elevated price levels. Please refer to the inside back cover of Selection and Opinion for our statistically based asset allocation model's current reading. The current economic situation remains difficult, and it's going to take a while to recover. The number of COVID-related deaths now exceed 300,000, and though vaccinations are now being provided to frontline workers, we think the general population will increasingly opt to get vaccinations in coming months. But 2020 was a strange year, not only in our daily lives. It was often peculiar to many stock market observers. Despite the incredible hardship experienced by many Americans, the stock market was somehow insulated from the repeated problems faced by the economy. The major averages recovered their entire plunge from their March lows and look like they will finish in positive territory at year-end. Aggressive, dovish global monetary policy coupled with fiscal largesse overcame the demand setback created by the pandemic. The adage that the stock market is not the economy certainly proved true this year, but although we are cautiously optimistic about 2021, it is something to bear in mind as recovery optimism strengthens and valuations increase. On that note, ValueLine is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, ValueLine provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of ValueLine's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard. So we go to the presentation. Once signed in, head to the dashboard where I'm already located. You can see that on the upper left-hand side. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Individual companies are dealing with an uncertain recovery and have cut costs where possible. The bulk of headcount reductions, the slashing of advertising budgets, and suspension of dividends have likely already occurred. Looking forward, an estimated 5 million households are facing eviction and job additions are decelerating. Investors will be challenged to gauge how corporations and individual spending habits shift post-COVID-19. Due to altered balance sheets, ValueLine has been reviewing and adjusting our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary ValueLine measure, are the two metrics that are used to calculate a stock safety rank, a measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. Okay, on the left-hand side, just to repeat, you can see The stocks that are scrolling on the left-hand side where newsworthy items have occurred during the course of the day, and ValueLine will adjust these as news crosses our desk, as I mentioned prior. Just going forward here, again, for more information in regard to our proprietary ranks and ratings, ValueLine provides a user guide that can be accessed via the investment education section of our website. Lastly, it's a good time to mention that the case for individual stocks is quite strong over broad index funds. Certainly, particular industries and sectors will recover more quickly than others during and after this pandemic runs its course. So now we will go to the screener and look at the one stock to buy right now. For this, let's go to the screener. ValueLine subscribers have access to about 15 preset screens and 50 fields. If you scroll over to the middle of the page, you'll see the Find Ideas tab. And it's very slow to open, but once it does open, I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-ValueLine. Again, please call 1-800-ValueLine for more information on the higher level of subscription for the 15 preset screens and 50 fields. Since I earlier preached caution, I am going to create a screen that emphasizes the most stable and successful issues. There are loads of risk measures out there and several that ValueLine offers, and I'm going to start with our time-tested safety ranks. The safety ranks measure the total risk of a stock, and it's arranged on an easy-to-understand scale of 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that the stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. At the same time, they also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. So, in terms of the screening criteria, let's go through the steps. I'm only going to focus on those stocks ranked 1, highest for safety. These are the largest, most stable equities under our coverage universe. In fact, of the 5,700 or so stocks in our database, as you can see, as the filter is applied, hopefully successfully, only about 128 garnered this top ranked as of yesterday. I believe I was on there earlier today, and it may have changed 1 or 2 stocks. Now from there, having established that filter, let's narrow down that list a little further by looking at price potential in the year ahead. For that, I am going to include timeliness, which is a proprietary ValueLine measure evaluating a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. I want to focus on the stocks that, based on our projections, have the most promise in the near term. So I'll set the screen to stocks ranked 1 or 2. Now, we want to whittle the list down even further, and for that, I'm going to focus on the 18-month target price. This is a relatively new feature that is based on a set of proprietary quantitative factors, and by setting a minimum requirement of 20%, if you scroll to the right from that bar and get to 20%, we have narrowed our pool of stocks even further. Lastly, I'm going to select the dividend yield. this is a good time to mention that ValueLines analysts create projections out 5 years, and very few research houses provide that long-term view. I'm going to set the low bound to 2.5%. This will surely narrow down our list even further, and sure enough, it comes down to, I believe, 9 or 11 stocks there you'll be able to see. And as you can see, all these companies with long track records of steady increases to the payout, but they also have decent appreciation prospects based on our timeliness rank and based on our 18-month target price. You can certainly make an argument for any of our remaining stocks, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of my senior analysts, we prefer to recommend Merck, ticker symbol MRK. Before I go into specifics, please note that screens can be saved and revisited by utilizing the button at the top. Let's now click on Merck and get some additional information from ValueLines' digital report. The COVID-19 pandemic has affected Merck in a mixed fashion. The company's flagship drug, Keytruda, continues to post phenomenal results, and animal health drugs have complemented this growth and helped balance modest declines in other product segments. Although Keytruda is becoming a larger percentage of sales, we are encouraged that it continues to find more uses and will not go off patent for 8 years. Meanwhile, the political threat of price caps hasn't been as powerful this political season among the chaos of the pandemic climate and the political season. We think Merck's relative valuation, which is hovering near historic lows, provides an element of safety as well. In the banner section of our reports, you will notice that the stock is now trading at roughly $80 per share, and our 3 to 5 year target price range is $100 to $125. Now, let's take a look at our last full-page report, which was published in October, and as you can see in the statistical array, or the center of the report that includes the financial data, Merck appears poised to achieve healthy annual increases in profits and book value, among other measures. We look for the company to post decent results this coming year, regardless of how the overall economy fares. Merck share earnings are expected to have increased to $5.70 per share this year and $6.30 in 2021. Again, we are heartened by the cost reduction measures, which fell 12% in second quarter, and even though rivals have taken the lead in terms of coronavirus vaccinations, we don't think this will impact the stock price. Keytruda is approaching a third of sales, and we think it will find more progress in studies applied to different forms of cancer. Additionally, the company's ability to record decent profit growth despite smaller contribution from other more discretionary drugs within its portfolio gives us comfort as well, though we suspect that increased physician visits in 2021 will help revive volumes of all drugs, including those discretionary drugs. The company's balance sheet is in pretty good shape. Cash exceeded $11 billion as of the end of the June quarter, and the capital structure is evenly divided between equity and debt. The company's dividend yield exceeds the ValueLine median and has been raised annually over the past decade. We look for this string of hikes to continue, considering the dividend payout ratio is relatively low, historically speaking. Also, the equity holds our highest score for earnings predictability, while the company has a near-perfect score of 95 for stock price stability. All told, we think that Merck's position is quite strong, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, we recommend a review of our latest reports. The first few were submitted prior to this presentation.
Okay, Alan, why don't you go ahead and take the first question? Okay, thank you everybody, and thank you for the presentation, Charlie and Sharif. The first question that I came across is someone asked, what is the distribution of the timeliness ranking system? Is it, there's 5 ranks, 1, 2, 3, 4, and 5. Is it 20% each, or is it more of a bell curve? The answer to that is more of a bell curve. There tends to be more stocks ranked 3, and then less ranked 2 or 4, and then even fewer ranked 1 or 5. So it's kind of like your standard bell curve, where there's more towards the mean is more towards 3. So if you see 1 or 5s, there's fewer of those than you would see 3s. There's a few more 2s and 4s. So it's not 20% each one. It's more of a bell-shaped curve. So just wanted to address that question to start off. Thank you.
Okay, thanks, Alan. We have a question here. We've had a number of real estate-related questions over the past several weeks. We have an interesting question here. What is ValueLines' outlook, basically, about the real estate sector? Is there a specific type of real estate that we expect to perform a little bit better than others, or than the real estate market in general? So our outlook really hasn't changed much about the real estate sector, and it diverges depending on the type of real estate that we're talking about, and it also diverges based on the type of investment vehicle. So, for example, single-family homes have been in very high demand over the last year or so. The demand really has been driven by the emergence of the millennial generation and their desire now to form household formation. So what that means is, people in the millennial generation are at an age where they're starting to get married, have children, and they're looking to buy homes. So it's the millennial generation. It's also historically low interest rates. The Fed has been very accommodative in that regard. And it's also been, obviously been sort of bolstered during 2020 by a desire to get away from dense urban areas with high population density, where people want to get away from very high density areas and move away to areas where it's they have a little bit more room to breathe, a little bit more space. The advent of the work from home phenomenon has also been a big driver. You don't have to be immediately adjacent to the population centers, New York, San Francisco, Chicago, et cetera, to find employment and to maintain employment. So the ability to work from home or to work remotely has certainly been a driver there as well. So that's one area. So you're looking at single-family homes. That's been a big driver there. So what are the services or the types of companies that would service or benefit from the single-family home, the explosion or the demand for single-family homes? It would be your home builders. It would be D.R. Horton, Toll Brothers, that type of company. It would also be the home improvement centers have done very well. Lowe's, Home Depot have done very well because not only are people buying homes, people are investing in their homes. They tend to be smaller scale projects at the moment, rather than your full scale type of renovation. It's more maintaining their homes, making modest improvements, and that has been very beneficial to the home improvement sector. Lumber companies, home improvement sectors, home improvement providers, that type of thing. Now, an area that has struggled over the past year, in particular during the pandemic, is the office sector, and it continues to struggle. Vacancy rates are at the highest levels in recent memory. And their questions remain. Will employers require their employees to come and work in person? When will that return? And to what degree will they require their employees to return in person? That will certainly have an impact not only on vacancy rates, but on rents. And also bear in mind that many of the many companies in the office sector, the debt levels tend to be a little bit higher than other types of real estate, just because of the substantial capital-intensive type of investment that's required to make to buy your large office properties, especially in your first and second tier markets, such as, again, New York, San Francisco, Chicago, Dallas, etc. So we expect the office sector to continue to lag behind the broader real estate market in general. As far as the type of investment vehicle, we would look again at equities of your home builders. I think that would be a good area to look. REITs obviously are a very common way to invest in the real estate market for an equities investor. But not all REITs are created equal. There's great disparity in the prospects, the near-term prospects for different types of REITs. For example, REITs that specialize in your distribution centers, self-storage centers, data centers. Their prospects in the near term continue to be very strong. So that would be companies like Duke Realty, Public Storage, Extra Space Storage. And then if you're looking at areas of the REIT market that are their prospects maybe are not quite as strong, it would be your office landlords, companies like Boston Properties, Vornado, SL Green. Also, some of the retail REITs, companies like Simon Property Group, they may struggle a little bit over the next maybe the next year or so, as consumers start to kind of slowly get back to shopping more so in person rather than shopping remotely. So that kind of wraps up what our outlook is on the real estate market, at least for the next year or so. Alan?
Thank you, Sharif. The next question that I came across was somebody asked, Christian asked, how come the screen search had it at a timeliness of 1, but when we pull the report it had a timeliness of 3? That's a very good question. And as you can see, the latest report by ValueLine, the latest full-page report was written on October 2nd, 2020, which is, about 2.5 months ago or so. And at that moment in time, the stock was ranked 3 for timeliness. But we update our timeliness rankings on an as-needed basis. It's not weekly or anything like that. It's usually when news comes out or price movement warrants a change in timeliness rank. We publish each stock in our survey once every 3 months. So we wanted to, the timeliness rank will sometimes change or often changes during those 3 months. So what you're getting when you go on the ValueLine website and you put the ticker in and it pulls up the stock, you're getting the most up-to-date timeliness rank on that stock. So it supersedes whatever timeliness rank you'll see on the page. So I just wanted to clarify that was an excellent question. So that's why it's the one that you pull up that Sharif just pulled up. As you see, for Merck & Company, is a timeliness rank of 1, and that's the most up-to-date one. So thank you.
Okay, thanks, Alan. We've got another interesting question here. This one's a little bit more of a broader question. So the question is, do we, with the election now in the rearview mirror, do we expect any, let's say, an appreciable difference in the Federal Reserve's stance regarding interest rates, et cetera? So ValueLines' outlook really remains largely unchanged. Jerome Powell remains in place as the Fed chair. He has made it very clear that the Federal Reserve will remain accommodative, low interest rates, and continuing to inject liquidity into the market. That has been the Fed's stance for some time now, and I think that will continue. Janet Yellen is Mr. Biden's projected nominee for the Treasury Secretary. Ms. Yellen is a known commodity. She is somebody that is very well known to the investment community. And we expect the Federal Reserve to remain very accommodative. We expect interest rates to remain near their historic lows. And we expect more liquidity to be injected into the market. So we don't anticipate any big changes, let's put it that way. We think that it will, the atmosphere and the environment will remain very beneficial to stock investment. And we don't expect any major changes there for the foreseeable future. We think it's a good time to invest. It has been a good time to invest, and it will remain a good time for the individual investor. Alan, anything else jumping out at you at the moment?
Yeah, actually, I have another interesting question, Sharif. As far as how often the ValueLine info is updated, the ValueLine information is updated. And as I said before, we update each of our 1,700 companies once every 3 months. That's not to say that we don't update in between, because we do something, publish something called a supplementary report. This is done when there's breaking news on a company. For all the Dow 30 companies, this is done whenever they report earnings. So if there's any substantial change to any of the companies under our coverage, we will issue a supplementary report, and that's issued in a timely manner. It's generally done within, an hour of any breaking news that comes out on the company, whether it be an earnings miss or, earnings outperformance or a potential merger, things of that nature. So we do update, keep the companies updated. And you could look to that, as Charlie alluded to, in his presentation on the supplementary report section of our website. Thanks.
Just to piggyback on what Alan just touched on, I'm just going to give our participants here just a look at what Alan was talking about. If you can see here on my screen, you have on the ValueLine homepage here, on the basic dashboard, you have all these different areas that you can look at. You have the summary and index, selection and opinion, et cetera, and here you see supplementary reports. And this is where you get an overview of the latest supplementary reports that have been written by ValueLine analysts. And it just gives you all the different supplementary reports that have been written, and it's all dated that you can see the companies here. And let's just click on one just in general. Let's take a look at Rite Aid. And here you can see what a supplementary report looks like for those of you that are not familiar. And it just gives you sort of a quick overview of, as Alan said, noteworthy events. If a company just has reported their quarterly results, so we'll issue a supplementary report that will detail what those results were. So, for example, Rite Aid here has just reported their third quarter financial results, and we'll give you sort of an overview of what the results were. Were they better or worse than expectations, our expectations, market expectations? How did the stock react to that news. So here it says that investors were obviously pleased with Rite Aid's November quarter performance. Just to give people an idea, for those of you who are not familiar with the ValueLine supplementary reports. Alan, anything else jumping out at you? I'm not seeing anything else at the moment that's grabbing my attention.
I have one here that kind of caught my eye, and also someone asked, how often are the 3 to 5 year projections updated? And our 3 to 5 year projections can relate to the 3 to 5 year target price range. That's part of one of the factors that goes into our 3 to 5 year target price range. And our 3 to 5 year projections are generally updated once every 3 months, along with the with the ValueLine page for a particular company. That's not to say, if things haven't changed, or sometimes our 3 to 5 year outlook hadn't changed in 3 months, therefore we'll leave it the same, but quite often we'll change it. And also worth noting, once a year we roll out our projections for another year. Like right now we're going out to the 2023 to 2025 timeframe. In a few months, I believe early into next year, we'll be rolling that out to 2024 to 2026, and in many cases, based on the annual earnings growth, et cetera, we'll adjust the 3 to 5 year earnings. So that was another excellent question, and we do we focus on that as well as our near-term performance indicators, such as the timeliness and the technical rank. So thank you, Sharif.
Okay, Alan, I think we are just about ready to wrap things up. But for anybody that has questions, any existing or prospective subscribers to ValueLine, if you have any questions, you can always call. That is 1-800-ValueLine. And that is exactly spelled out exactly as it sounds. That's 1-800-ValueLine. You can also visit www.valueline.com if you have any questions about subscriptions and the services that ValueLine provides. And with that, I think we are ready to wrap things up. Thank everybody for participating today. Take care.